Hey, what up YouTube? Welcome back to my investing channel. As usual, I'm your host Calvin, and today we got a pretty nice set of topics that we're going to be talking about today. We're going to be looking at market volatility and understanding the warning signs of a market crash, or what kind of goes into a market crash. So before we get started, if you could, scroll down, hit the subscribe button, smash the like button, I appreciate all the support. I also want to note that I am not a financial expert, so please contact an expert or an advisor before you begin to invest. And as always, I don't know if I could stress this enough. Whenever you are going to invest or buy a stock, please do your due diligence. Information is key, and you always want to be well informed when you're purchasing a stock. All right, without further ado, let's get into it. So the market, as you can see on Friday, was very wild. The SP 500 was all over the place. The Dow was deep red. NASDAQ was kind of all over the place before it popped up to about 250 and then dipped during power hour. So in general, last week was a pretty bloody week, but I think there is going to be a lot of bullishness to come. But here's kind of the telltale signs of a market crash. The first one is going to be the VIX. The VIX is, in a way, is a measurement of volatility. It's created by Barclays. As you can see in March, with the first flash crash, you have VIX, shooting up and hitting an all-time high, or a yearly high of 79. You can see that it was pre-crash. It was hovering in the 14 to 16 range, and it just moonshotted, right? And then shortly after, it slowly came down, and hit the 27. This was kind of the time when the market was quote unquote recovering, and airlines were back up significantly from their all-time lows, and then you see a spike right here, and the spike is the couple days after when we got hit with the wave 2 of COVID. Airlines continue to crash, and then you could see a rise of VIX again in September, when we get another market sort of quote unquote short crash. Part of it was due to the report that came out with SoFi and gambling on futures, but the other part was tech was overheated and there was a little bit of a dip. The same thing happened in late October. There was a little bump in VIX, and then you can see shortly after, VIX has climbed down significantly, from the beginning of November all the way to the end of January. There was during this time period, the market really performed extraordinarily well. You can see that we had a ton of green days, and we had a lot of bullish sentiment. And then you see a little jump in VIX, and during this time was sort of the GameStop, AMC meme stock fiasco. While they were going up, the rest of the market was taking a hit. So there was a lot of volatility in that period. You can also see VIX start to climb up again before dipping again the last couple of weeks, because there was a lot of bounce back, a lot more positive movement. And then you can see this last couple of days, VIX has started to come up, but it hasn't even really moved a whole lot, which tells you that, hey, the futures volatility index hasn't really shown the telltale signs or the warning signs that a market crash is imminent. If a crash was coming, you would expect maybe a couple of days of VIX moving in green, like 2 or 3 days where it really pops up, and that's going to be your warning sign. Hey, get out of existing contracts, or make a move to kind of hedge against volatility, right? You don't want to be caught in a crash. So if you see something like this, where there's like an inside candle and a big jump and another big jump, that could be your kind of warning sign to, hey, I might want to get out of some of these positions and hold some cash so I can buy the dip. You can see that again in September. You see a couple of 3 green days and then a huge pump, and then it comes straight back down, right? So if you see, like, I would say 3 or 4 days in a row where VIX is going up, you want to really be careful about buying into new positions. You might not be able to buy the dip, but you're also going to have a lot better understanding and a way to protect yourself in case the market does crash. But right now, with VIX kind of hovering right here, it hasn't really put together a string of green days. I feel confident that that crash is not imminent, and there's a lot of room for a good bounce back, as VIX is still kind of close to that all-time low range. Now the other one is the bond market. It's called TLT, which is going to be the 20-year Treasury bond ETF. This is another way that investors are going to hedge against market uncertainty and volatility. What happens is as the market gets more volatile, more people will be buying bond funds because they're pretty safe. They give you consistent return, which are pretty damn small, but it gives you a sort of a consistent return, right? So as you can see, as the market crashed right here, bond rates jumped from their bottoms. So what happened was the market crashed, everything crashed, right? Flash crash. And as soon as volatility went up, a lot of people grabbed bonds, and bonds just came back up. It came back up. It dipped because of the bullish market sentiment, right? So from here to here, we had a lot of positive movement in the market. Everything was doing well. And then we had another mini crash, which sees the bond rates go up. This is sort of some uncertainty, and it dips a lot right here, which means that the market was kind of performing pretty well. You see in September, we have like a little mini crash, another telltale sign. 4 days of positive movement for the bond fund. And you can see, let's see if I can chart it. From here to here, right? It's a pretty nice downward movement, and then you see this big green candle right here, which was the upward movement last Friday, I believe. Let's see. Yes, it was last Friday. There was a huge green candle, and that kind of told that was sort of a pump due to volatility and bond rates. And what's going to happen is that if you see the bond rates continue to increase, that's another warning sign that volatility is coming, and that you got to really be careful about what you're buying into. But right now, with TLT still hovering around the 140 range, or at the 143 range, I think you're still pretty safe at the moment. So with that being said, those are kind of the two things I'm looking at when determining whether a crash is imminent, or that there is a lot of room to recover. I like to look at the 20-year Treasury bond, as well as the VIX, the iPath short-term futures for the SP 500. Finally, another thing you could look at is going to be what used to be gold. Let's see if we can find it. It's GLD. Gold, you can see that it does tend to rise, but with the first, let's see, crash right here, gold shoots back up. Gold is a good hedge against volatility, but I really don't know at this point how much better gold can do. Bitcoin has kind of taken over gold's role in a hedge against volatility, and it feels like there's not a lot of accurate movement you can use from looking at gold at this point. This might change in the future if Bitcoin starts to decline a lot more, but right now I don't really like to look at gold too much. Alright guys, with that being said, thank you guys so much for tuning in. This is just a quick segment on how to spot market volatility, uncertainty, and couple of telltale signs of a market crash and why I think the market is not crashing at the moment. If you could just show your support, scroll down, hit the subscribe button. I really appreciate it, and I hope to see you around.